Yesterday, we talked about, you remember we talked about innovation and value proposition as the foundation of your business plan. And we dealt with the questions of starting with, why do we want to have an innovative product, service, business model? What are the benefits that we get from innovation? And then we talked about value proposition, which is what is the painful customer problem that you are addressing with your innovative product, business model, solution. And we came to the conclusion that the value of having an innovative product that solves a painful problem for customers is that we can begin to mitigate the most common risk of failure for startup companies like the ones in our program, which is that insufficient demand will materialize for the product when they launch it. So, of course, having an innovative product that solves a painful problem for customers doesn't eliminate the possibility that there will be insufficient demand. However, at least it gives us some reason to believe that there may be sufficient demand. This is an important factor in investment decision making. We're trying to make some predictions about what's going to happen in the future. And since nobody really knows what's going to happen in the future, we look for evidence in the present that the future might go our way. So in this case, since we have underlying theory that people tend to buy products to solve painful problems, if we have identified a painful problem, if the existing solutions for that painful problem have significant shortfalls, then we can arrive at a reasonable assumption that there may be sufficient demand for this product. But that's step one. Now, step two is why, given that there might be sufficient demand for the product, what is the next most likely reason that our company is going to fail, that the startup company is going to fail? So let's say we do, in fact, have an innovative product that solves a painful problem for customers, and let's say, and in fact, there is a reasonable amount of demand for that product, but why next might the company fail? What's the next big risk that we need to deal with?
Distribution.
Well, we're going to have to deal with that too, but let's say even before that.
Before that.
Okay, so I think that's one. We may, there may be sufficient demand for the product, but in the wrong market, or we may go into the wrong market. And what's the other big risk?
Or the customer acquisition cost too high.
Yeah, that's another important part challenge we're going to encounter in the next phase. But okay, in the second step, so for me, I want to look at it like this. Now we have a reason to believe there will be demand for a product because it solves a painful customer problem. That's step one. But sufficient demand. What creates sufficient demand? What creates sufficient demand is two things. One is there exists a large enough market for this product. It might be that there is demand for this product, but that the total size of the potential customer base is just too small.
Yeah.
You know, imagine there's incredible demand for this product, but only from one customer in the whole world. Now, we have established that there is going to be demand from that customer. Now, is this going to make a successful company? Let's say there's demand for this product because it solves a painful problem, but it only solves for one customer in the whole world. Will the company be successful?
Yeah. It can be.
Actually, it depends, right? It depends on who is that customer.
Yeah.
If that customer is like the national government, but if that's an exception case. So if it turns out that there is demand for the product, but the market is not of sufficient size to enable us to scale, then we're going to have a problem. So second problem that we're going to look at today is, okay, we need to ensure that the market that we're targeting for our product is of sufficient size for us to scale. And we also have to determine, second, that we are entering this market through the right segment. So these are the two challenges we're going to deal with today. How do we determine, or how do we get confidence that the market that we are targeting is of sufficient size to enable us to scale? And having established that, how do we identify what is the right or best segment for us to enter this market through? So this is, these are two very common mistakes that startups make. They're targeting a market, that is just too small, or they entered a market that might be sufficient size, but they entered through the wrong segment. So I call this exercise market identification and analysis. So first, I'm going to look at the second problem first, which is identifying favorable market segments to enter. So what are characteristics that we look for in markets, and within those markets at market segments, that indicate that these markets and market segments are going to be attractive for us? Now, I think when I talk about entering a market or entering an industry in these slides, you should keep in mind that this can refer to a segment as well as an overall industry. So each market has many different segments, and different segments in the market will have different characteristics. So first thing we want to look at is we look at the nature of the returns in this market. So is this a market that is characterized by increasing returns or not? And this is almost a definition of scalability. Is the market characterized by increasing returns? So in increasing returns markets, upfront costs will be high relative to marginal costs, which means marginal costs will be low relative to upfront costs. And this is just another way of saying this market should support scalability, and another way of saying we strongly favor product-intensive markets over service-intensive markets. So if you think about comparing like two types of businesses, or two types of market, let's say a mobile app versus a restaurant, or actually have a mobile app product versus application development service. So let's say the exact same company in two different markets. One market they're in is developing a mobile app that they're going to launch on the App Store. Another market that they're in is developing apps for others. So which one is an increasing returns business? The first one, right? The first one is increasing returns business because why? Because we will incur relatively high upfront costs when we have to spend on product development of the app. So we will have to hire more people, and we will invest a lot in developing the first version of the product. But once we have developed the first version of the product, the working version of the product, and rolled it out through the App Store, then our marginal costs are relatively small. Our marginal cost then just becomes our customer acquisition costs. and whatever maintenance costs we have on the app or additional development that we have to do. But if we are doing app development, then our upfront costs are very low because we just have to acquire customers, but then our marginal costs of satisfying each project are very high because we have to apply a lot of resources. So that's just another way of saying that we like to look at markets where we can scale. Network externalities, and all of the next ones. So network externalities, complementary technologies, producer learning, and switching costs are all characteristics of markets that will help us to create competitive advantage later. So I'm going to go through these in more detail in the competitive advantage section, but basically these features of the market enable us as an early mover into this product category to create barriers to entry for competitors who follow us into the market. So, network externalities. Did we talk about this already? What's a network externality? Or what's an example of network externality? So a network externality is found in a market where the actions of one participant in the market affect the value for another participant, another kind of participant in the market, and vice versa. Example, when we talk about Apple and iPhone. So what was the innovation in iPhone? Say that.
It is the first mobile phone with the touch screen.
Okay, so that's some technology innovation. And what else? I think maybe other phones have touchscreen, but they have the multi-touch Apple. And then what else? Yeah, better user experience. But and what else?
And applications.
Yeah. So the key, I think, key innovation in the iPhone was the changing business model. So previous smartphones just sold basically hardware with some software built in. Apple pioneered the business model with the iPhone of App Store and apps. So they released the iPhone with attached with a complementary App Store where customers that bought iPhones realized that they realized, wow, what I need, the reason I want a smartphone is so I can run apps. This was a huge change in the customer perception of smartphones. And at the same time, app developers realized, hey, I can make a lot of money, or I can distribute very quickly my apps through the App Store. I don't need to go try to sell software on the PC anymore. So this creates something called network externalities. How does that work? The early customers of iPhone realized, I want a smartphone that can run apps. And this causes app developers to write apps for the iPhone App Store. And this causes more people to buy iPhones. And this causes more developers to write apps for the iPhone App Store, which sells more iPhones. And this strategy almost by itself, I think, is responsible for propelling Apple to be the most profitable company in the world. Because this type of market, so a market that is characterized by network externalities and enables the companies in that market to execute a strategy that is based on network externalities, creates tremendous barriers to entry for followers. So look what happened to all Apple's competitors when they launched iPhone and App Store. Yeah, and then, but it took a long time for other phone manufacturers to catch up. Like Nokia, Nokia had, actually, who invented the smartphone? O2? Nokia. Who launched the first smartphone? Nokia, like 10 years before Apple. And they were the pioneer in smartphones. But they didn't get to the idea of smartphone with App Store until way too late. And then everybody else had to catch up, develop their own App Store. And this is why one of the key reasons you see Apple iOS is one of the contenders on mobile, but Windows Phone is nowhere because Microsoft was way too slow on their App Store. So another thing we like to see is switching costs. So does this market enable switching costs? This means how easy is it for your initial customers to switch to a competitor product when it becomes available? We would like it to be not so easy. The easier it is for customers to switch, the harder it is for early movers to maintain their competitive advantage. Let's say in some types of markets, people are ready to switch anytime. Like, let's say breakfast cereal. I mean, how willing are you to try new breakfast cereal? Maybe pretty easy, right? But computer operating systems, it's not easy to switch because you have a lot of switching costs and complementary technologies. So you have to maybe buy all new software. You have to relearn how to use the operating system. You have to maybe have peripheral devices that work with the current operating system. So we like to see market segments that enable switching costs, network externalities, complementary technologies. And again, when you think about the markets that most startups are in, they have these characteristics. Okay, we look at fast-growing segmented markets. So we want markets that are in the high growth stage of market development. And this is because, for several reasons, one is that new companies will have a less difficult time competing in fast-growing markets than they will in large, slow-growing markets. Let's look at it this way. Let's say you're a new company entering a new market. You're a new company in a market. Where are your customers going to come from? What is the source of what is the source of your customers? So one possible source is you capture customers from competitors. So customers who are already in the market but are currently receiving service or buying product from competitors. What's the other source of customers?
Those who don't know what they need until your products.
Okay, so we might call those customers who are new to the market. So customers new to the market. So two sources of customers. We can get customers away from competitors, or we can capture customers who are new to the market, meaning just entering the market now. Let's consider two potential markets that we could enter. One market is currently $1 billion market, and it's growing at 1% a year. And the other market is $100 million market, but it's growing at 50% a year. Yeah. So which market do we prefer? The very large and slow-growing market, or the small and fast-growing market? Large and slow-growing, or small and fast growing.
I would actually go for the fast growing one because in that segment, it seems that the customers are keen early adopters, which means they are more easily switching over to our services and offering.
Yes, I agree. Thank you. And also thank you for answering a question from Zoom. I'm really happy. Yeah. And please don't hesitate. So, okay. So I think,
Okay, sure.
yeah. So I think the my answer would be, we definitely favor the market that's currently smaller and faster growing. For that reason, and another reason, if we think about the market structure, so the market that's currently $1 billion market that's growing at 1%, this market, it's a large market. So let's think about, what does the competition look like in that market? Maybe there's a few big players that each have a significant share of that market, or maybe it's highly fragmented with many small players. But the fact that the market is growing so slowly, 1% a year, means that everybody's growth, all the existing competitor growth in that market is coming from trying to take customers away from competitors. Because if they're growing based on new entrants in the market, nobody's growing more than 1% a year, and assuming they're splitting that even less. So that's not going to be very effective. So we can expect that this market will be characterized by fierce competition from established players, which is not what we want as a startup. So we don't want to be relying on our ability to take customers away from competitors if we can help it. We want to be able to fuel the growth of our company with acquiring customers who are new to the market. And if we are in a fast growth market, this means that by definition there will be many new customers added to the market on a regular basis, because that's what fast growth means. Now, why do we prefer new customers? Because if we need to take customers away from competitors, what is the likely reaction that we're going to get from competitors? Oh, louder.
Hatred.
Okay, I hope not, but possible, and definitely we're going to get retaliation. We're going to have to fight hard to acquire those customers. So if we're trying to steal customers from them, and especially if we're in a very slow growth market where everybody's growth depends on taking customers away from others, and we're a new player, we're not going to be well received, and we're going to have to be, the way I like to think about this, we'll be like fighting for our lives from day one, which we're going to be anyway, but we want to put ourselves in a more favorable position to do that. So we will look for large, fast-growing segmented markets. The markets may be relatively small today, and in fact, segmentation is also really important for us. We want a market that is characterized by segmentation, meaning has many potential segments for us to enter through, versus undifferentiated mass market. Why? Because it's very difficult or maybe close to impossible for a startup to enter undifferentiated mass market. Our whole market entry strategy is going to be built around finding an attractive market segment to enter through, and therefore if the market itself doesn't have segments, then we're in huge trouble. Okay, so now, next thing we want to look at is market timing. Because it's not enough for us to choose the right market segment to enter, but we have to choose to enter the segment at the right time. And the diagram that we're looking at here is called an S curve. And an S curve is a graph of that attempts to show the growth of a market over time. And this is a general shape of market development for new products and services. So what happens, the market will go through some period of very slow growth in the early days. It will then reach an inflection point, meaning a turning point. It'll then grow exponentially for some period of time, and then it'll reach a level of saturation or maturity, and the growth will slow down. It'll flatten out, and then there'll be a new market S-curve that starts here with a new product. So this is a pretty common trajectory for new markets. So where should we enter on the curve? Picking the optimal entry point is a very challenging task that we have as a new startup. So we want to make sure we're targeting a market that is at the right stage of development. Now, to see how difficult this is, we'll do an exercise. So I'm going to move the laser pointer. I'll move my mouse pointer along the curve, and when you think it's the right time to enter the market, you just shout out, enter. Okay, you ready? Everybody understand how the exercise is going to work? Okay. So here's the mouse pointer. Okay, ready?
Enter.
What moves so fast? Yeah, what happened? What happened? You missed it. You all missed it. Yeah, you all missed the optimal point to enter. Now, now why did I do that? Like, what does that mean?
The inflection point happens very fast.
It means, okay, it means this is what will happen in real life. In real life, we will never enter at the optimal point. Or another way to put it is, what's the probability that a startup will enter the market at the optimal point on the S-curve? What's the probability? What do you think? Probability that the startup will enter the market at the optimal point on the S-curve.
Is it equal to properties of the unicorn?
It's less. I would say the probability is, anybody want to venture a guess? The probability is 0. 0. 0. Why do I say 0? Let's calculate the probability. How many points are there on this curve?
Infinite.
Infinite. And how many, by definition of optimal, how many optimal points are there?
Only one.
1. So 1 divided by infinite equals what? 0. So the probability is 0. Now, what do I really mean when I say that? I mean, or what's the consequence of that? Because I think it's actually true, but what's the consequence of probability of entering at the optimal point being 0? What choices do we have now? That leaves us with only 2 choices. If we can never enter at the optimal point, we need to enter either before or after. So, where do we want to enter? Do we want to choose to enter before or after the optimal point?
Before. After.
Okay, so from the before side, why?
Waiting for that to happen. Waiting for the inflection point.
So if we enter before, then we may be able to wait until we hit it and then experience it. Still capture it, right? Capture the growth in the exponential growth phase. After what?
I think because sometimes we kind of have to wait. Because waiting, we're gonna have like a lot of cost of opportunity, like capital cost, and it's I think it's higher risk compared to like after it happened, and then I think it's much better compared to before.
You say before, right?
I say after.
No. But why after?
I mean, it's like, okay, because if we enter before the point, sometimes we have to wait, and waiting is not like free. It's definitely involved with a lot of cost, and because a lot of startup, they can't afford to wait too long, like lack of cash flow, so they're gonna fail. But if we enter after that point, and the market already happened, okay, there will be a good demand. So I'm gonna choose after.
Oh, okay. I mean, I think it's not a clear answer one way or another, and you can make arguments on both sides. My preference is for before. I'll tell you why. Like, I think you're right. There's a risk in both ways. There's a risk before, and there's a risk after. The risk of going in before is we can't wait too long. Okay, let's say, for example, let's just imagine, for argument's sake, that the inflection point is here. This is about where it looks like, right? If we enter here, it's okay. But what if we enter here? We don't know how long that gap is going to be. And in fact, the other really tricky part of this is the whole shape of this curve only becomes evident in retrospect. Meaning, we will only really know what this curve looked like when it's all over. And by the time it's all over, now it's way too late. So we're anticipating when this is going to happen. But I feel like in order for our company to scale, we must capture the growth around here. If we miss this growth, we'll never scale. And as the market grows, it's going to become harder and harder to capture majority of that growth because the market's already scaling, which means there's already somebody there that's capturing that. So for us as a very small startup, I usually think our best strategy is get in early, maybe a little too early, beat everybody else there, and hang on until we hit the inflection point. But of course, but we can get this very wrong if we're too early. So I would say, if we have a choice, I would prefer to go too early, but not too early. Of course, that's very difficult to tell.
Good question. So what industries do you think that are in right?
Yeah, so let's think about that. Let's look at that as an example. Like, let's say what markets are right here, right now. I'll tell you the one I'm thinking about today is, and this is a market that I've been watching for a long time. So I won't tell you what it is yet, I'll make a little suspense. But I first encountered this market in 1995 or 94, 95. And I was really excited by the potential of the market in late 1990s. And a few months ago, I went back and happened to go read some technology predictions that I made back in 1999 about what technologies, what were going to be the very exciting technology trends over the next 5 to 10 years. And I was right about a few things that seem obvious now, but were not that obvious then, like broadband internet, and like the dispersion of broadband internet, like the fact that internet was going to be globally distributed and not just in the US, like the growth of mobile computing. So I definitely hit the nail on the head with a few of these predictions, but there was one that was like, at least one that was totally wrong. Meaning over the intervening 5 to 10 years from when I wrote that piece till now, almost nothing happened in that market. But I believe that 2016 is the year where this market is about to hit the inflection point. So what is that market? What is that product? It's virtual reality. Virtual reality and mixed reality. Virtual mixed and augmented reality. So I remember in my 1999 piece, I was like, we're going to see virtual reality worlds exploding, which they did. And now what are the signals that I see in the market that virtual reality is about to break out? We see Oculus Rift, super successful Kickstarter project and then startup company, and then purchased by Facebook for more than $1 billion. On the other end of the market, we see companies like Samsung, Sony, even Amazon with very inexpensive, even cardboard 3D viewers. Microsoft developing their own mixed reality and virtual reality products. You see Magic Leap, it's another very well-funded startup that's doing an augmented reality product, hundreds of millions of dollars of investment. We saw the breakout success of Pokemon Go, which is like a mixed reality product. So yeah, I think if I was to think of a market that's hitting the inflection point now, it would be more of a virtual mixed and augmented reality, which has been in the long, which has been on this long, flat growth part of the curve since like the mid-1990s, which is 20 years, right? I mean, I first heard about virtual reality products back then. I don't even know if that was there might have been even some products before that. So many, many startups that thought, they were at the inflection point of virtual reality died, waiting for the market to take off. So, but 1996 was too early, 2006 probably too early, but maybe 2016 is just the right time. Or even 2015, was okay. So another product I like to look at to think about this and how we can die on the flat part of the curve is desktop video teleconferencing or personal video conferencing. Like, do you remember when the first personal video conferencing technology was demonstrated? What year? Yes, what was the? 2000. Okay. Anybody remember anything before that?
Yahoo Messenger.
How about what year? Okay, anybody else? I saw my first personal video conferencing product demonstrated in 1965. What? 1965. Yeah, 65. Yeah, nobody here is even born yet, right? Even your parents are just born. That's for some of us. No, none of us are. Only me, I think, is born. So, but yeah, I remember seeing it. I was a small boy, and I saw a product demonstration of a personal video conferencing technology, 1965. Now, of course, this was very early days, but there were many video and even audio desktop audio conferencing products that developed in the late 1990s that were still too early. And finally, Skype was the company that really entered this market at exactly close to the inflection point and was able to build $1 billion company on desktop audio and video teleconferencing. And what happened there was a couple of things, but basically, I think the underlying infrastructure to support desktop audio and video conferencing was not in place until early 2000s when enough people were on internet bandwidth got big enough, and the latency in the calls got reduced enough. If you remember using like the internet phone call in the 1990s, mid-1990s, the early products, they suffered from latency in the call, where I would call you and I would say hello, and there would be like a gap in between me saying hello and you hearing, and then you would respond, and then there'd be a gap, and it was like very difficult to adopt these products just because of very small degrees of latency, because there's a latency threshold above which we're not comfortable using the product. So when the threshold fell below that, that's when we started to see this product category really taking off. The same thing with the virtual reality. I think the reason virtual reality is taking so long to take off is because we have very high threshold for effective interaction with virtual reality environments. So, and the hardware and software, and the cost of hardware and software, and the size and power requirements to create these virtual reality environments have been out of reach for products, mainstream products up until now. But now you can see we can even use smartphones. We have so much power in small devices now that we start to get to the point where there can be a potential breakout. So, yeah, I would think about your market. Where is your market in terms of market development? Is it in the right stage of development for your startup or not? If it's the wrong stage, then you want to think about your segment. So remember, these curves cannot just describe whole markets, but they will describe segments within markets. So, for example, let's say the mobile phone market as a whole maybe not growing that fast, but segments within the mobile phone market are growing extremely fast. Say in every different product category or every different market. Okay, let's say in accommodation, the hotel market is not growing that fast, but the market for peer-to-peer accommodation is growing very fast. So think about which are the segments within your market that are in the right stage of S-curve development to support your startup.
What about VC funds in Vietnam?
Oh, VC in Vietnam. So actually, I believe that, so for me, venture capital, it's part of a larger market, which is, I call enterprise ecosystem. Enterprise ecosystem. So, but putting that aside for a minute, I would say the VC market in Vietnam, venture capital market, it's about here. Yeah, I mean, so I believe that the venture capital market in Vietnam is, Southeast Asia in general, and Vietnam specifically, is reaching an inflection point now. I think this is why one of the main reasons we're so excited about this market, because we do the same thing. As an investor, we're also always looking at where is the market that's reaching inflection point. And for our business, I think both the enterprise ecosystem and the venture capital market are hitting an inflection point in Vietnam 2016 and probably 2017.
And we start going into the inflection point also 10 to 15 years. Correct.
I mean, in that market or in general?
In that market.
Yeah, I'm not sure about that. Like, okay, I date the beginning of the venture capital market in Southeast Asia in 2006. So, I mean, I arrived in Southeast Asia in 2000. From 2000 to 2006, I think there wasn't much in the way of venture capital markets in Southeast Asia as far as I could see. There were some venture capital companies, but they weren't doing what we consider early stage venture capital, which is what most people associate with venture capital. Most of the longer term players in venture capital space here, they're more like later stage VCs doing more of private equity deals or almost private equity deals. So I think I think probably we're about 10 years into the growth of the venture capital market, and we're starting to see some of the countries, again, so in the venture capital market, we have to look by country. So I think Singapore's venture capital market has already hit an inflection point. Thailand venture capital market is hitting an inflection point this year, I think, and I've been going to Thailand also for 12 years, and I think Vietnam looks to me like it's probably poised at the inflection point within the next 1 to 2 years. So, of course, that's a great time to be a startup. And I think that's one of the exciting opportunities for Vietnam-based startups now is that the venture capital industry itself is starting to hit an inflection point, which means that the amount of funding available for startups is going to grow exponentially, which means that the startups that are raising money now are going to be in a great position as the market expands. But just to finish up my discussion about enterprise ecosystem, like venture capital markets or venture capital companies are involved in a process that requires an ecosystem. Ecosystems are interrelated systems where each of the parts will support the other parts. So this is a very special type of environmental condition that makes it extremely difficult to do something new or to introduce something new. It also makes it very difficult for, it's also very difficult to get started, right? Because imagine, like, let's say in a natural ecosystem, you have the food chain. So how does the food chain get started? You know, because until there's at least two participants in the food chain, it's never going to work because the first participant can't eat themselves, right? So but in nature, like the food chain gets started because plants eat sunlight, right? So plants are able to eat sunlight, and then everything else is able to eat sunlight indirectly through the plants. So plants get energy from the sun, and then animals eat the plants, and then animals eat the animals to eat the plants, and so on. So yeah, so we're able to start those natural ecosystems. But how do we start a venture capital ecosystem, a startup and venture capital ecosystem? Because startups need money to grow, but venture capital companies need startups to invest in. So before their startups to grow, so usually we look at key players are the startups, the venture capital funds, the incubators and accelerators, government, and the institutes of higher learning, research institutes, and industry. So the way that the ecosystem usually gets started is universities and research institutes and other institutions of higher learning graduate potentially young entrepreneurs, and also help develop intellectual property that forms the core of startup companies that then go into incubators or accelerators that then help to equip entrepreneurs with the skills that they need to grow, and then the entrepreneurs then raise money from early stage venture funds who and then raise more money from next stage venture funds and ultimately work with industry to sell products. And this is generally all supported at the early stage of government or large companies who provide subsidies / resources. And then once some of those companies get to a certain stage of development, they exit into capital markets, and then this funnels money back to early stage investors who then repeat the process.
These angel investors.
So angel investors, I would put angel investors in the category of related to early stage venture. Okay, so next thing we want to look at is what are the characteristics of the market's life cycle development that makes them more attractive to strikers. So the first thing is you want to choose a young market. We've talked about this already. If the market is at the early stage of development, there will be more demand and less competition. There'll be higher growth in demand, and there'll be fewer companies competing for the resources in that market, because that's what market growth means. The next thing we like to look at is a market segment where a dominant design has not yet been adopted. So the lack of existence of a dominant design underlying design is a very good indicator that this market is favorable for startups. And now let's try to understand better what that means, and then also look at what's the reason for this. What is the underlying infrastructure in the IT market or technology market? It's what? What's the infrastructure that supports all, let's say, all computing on the software level? What's the most basic level of software? Operating system. So the operating system is the infrastructure in the IT industry. And therefore, we want to look at is there a dominant design in the segment that we're approaching, that we're entering into, in the underlying infrastructure? So what is the dominant design in PC operating systems?
Yes,
Windows. So Windows is the dominant design of PC operating systems, and actually it has been for many years. And before Windows,
that's
DOS. So yeah, Mac iOS has never been the dominant design in PC. It's always been like 2%, 4% of the market. So now it's Windows. Before Windows, it was DOS. So that means what? That means as a software developer, let's say you're a software development startup, will you be writing software to install on the PC? Like how many software startups now are creating software to install on the PC?
It depends on the industry. Except for gaming, they not do anything on PC.
Almost nobody, right? And even gaming, it's moving more and more toward online gaming, mobile gaming. So PC software for startups is basically dead. Why? Because, most important reason, because of the overwhelmingly dominant design in PC operating systems. What about, what's the dominant design?
One question about PC gaming, because I saw the trend of growing of streaming through except for eSport and MMORPG. The other games are very much more still moving.
Yeah, but I'm still not going to invest in companies that trading software, that trading games to install on PC.
Well, as the market is about 200 million.
What about 10 years? What about 10 years from now? It's going to be zero.
Yeah.
You know what I mean? Like, I think I agree. Like, okay, let's say we look at if we look at the market for horse and buggy in 1910. Let's say, do we want to invest in horse and buggy in 1910 or automobile? I mean, actually, you know what's horse and buggy? You know what's horse? Yeah. So if you look at the size of the market for horse-drawn vehicles in 1910, it's huge. I mean, it was a giant market. The market for automobiles was tiny because most people, to travel around, they used a horse pulling a cart. I mean, pulling a vehicle. But in 1910, do you want to invest in horse-drawn carts or do you want to invest in automobiles? 20 years later, there's how many horses? Zero. They're all done. And I think something like in PC software, I mean, software installed on the PC, like 10 years from now, it's going to be zero. Or, like a teeny tiny fraction. So, like, why do people still install games on the PC?
Professional gamers, streamers.
No, but why are they installing games on the PC?
Oh, a lot more. There are a lot of reasons. I'm not going to get into the PC versus mobile, PC versus console, but yeah, there are a lot of people still playing games on PC.
But they're playing the game on the PC, or the game is installed on the PC?
The game is installed.
Yeah, so why are they installing it on the PC?
Because the hardware can operate the software. Because they say the hardware from the
performance, right? Performance. And but again, and that's like it. That's always been the case, right? If you look at, let's say your productivity apps. Like, how many of us are using I'm still using productivity apps installed on the PC. Like I use Microsoft Office on the PC. But I'm sure that 5 years from now, I won't be doing that. I'm sure 5 years from now, I'm going to be using Office on the cloud.
Yeah.
And the same thing's going to happen with these games. Like right now, the PC still, we still can only get the performance that we want from certain applications because the processing power of the PC and because of limitations in bandwidth. But these are just going to get lesser and lesser and lesser. Like, when you think about all the limitations that we used to have on things that we could only do on the PC that we now do through the cloud. And that's just going to continue. So I agree, like the market is still huge, but it's going to get smaller and smaller. So we only want to look at markets that are going to get bigger, not smaller. So, and also if you think about software developers, so are they focused on the installed PC market right now, or are they more focused on mobile market? Mobile. And why? Because what's the dominant design in PC and mobile operating system? Not yet. So it's still undecided. It's still a battle. So we have iOS and we have Android. iOS and Android, and they're still fighting it out. So this creates a fertile market for startups. You want to go into markets where there's an unresolved dominant design. Now, why is that good for startups? First of all, it creates more segmentation in the market, more fragmentation, and it also deters the entry of large players. If you think about, like, okay, let's say in the shift from DC operating system to the cloud, this was another one where there's one dominant player on PC, but in the cloud, there's competition between Google and Amazon and Microsoft. So they're still fighting it out in the cloud. And this enabled who to enter the productivity app market in a big way. Google. Google launched their own suite of Office products, Google Apps, that are based in the cloud, and everybody and Apple has their own suite of productivity apps in the cloud, and Microsoft has had to respond with Office in the cloud. And now we see real competition for productivity apps in the cloud because, again, the underlying dominant design is not resolved. There are multiple players running different cloud architectures. You see multiple operating systems in mobile. And this is why you see so many more startups in cloud, in mobile, than you do in installed PC. Now, what about IoT? What's the dominant design in IoT operating system?
It's Raspberry Pi.
It's even more fragmented than cloud. Actually, different IoT devices even have their own operating system. So there's much, there's much tremendous competition in the IoT operating system market. Again, that's a strong indication that it's going to be attractive for startups. Next thing we look at, next factor, we look at, is the market labor intensive rather than capital intensive?
Yes.
Welcome back. Welcome back, AgriHub. Let me just check it if I'm still there. Okay. Okay, so we want to look at markets that are labor intensive rather than capital intensive. Now, you might think this is inconsistent with what we talked about previously. We don't want service-driven businesses. So doesn't it sound like I'm saying the opposite thing here? It's not the case. when I say we look for markets that are labor intensive rather than capital intensive, I mean, we look for markets where people make the difference rather than capital, rather than money. Labor means people, capital means money. And therefore, this means we want to target markets where success is based on the people that you have, not on how much money you have. Why is this so important for startups? The reason is something, it's based on a concept that I call, or that's called fungibility. Is everybody familiar with that concept? Oh, I told you already, right? So, can you remember? So what was it?
Not much.
So you probably remember that. Anybody else? You may remember that it means if something is fungible, it's interchangeable. So money is interchangeable. You don't really care whether you have $100 bill or another $100 bill or 250s or anything. But people are not interchangeable. Like, how many people on your team? 3, right? So, and who are they?
Office.
Okay, so you have CEO and then CTO. So who's the CTO? Okay. So you're CTO?
Yes.
Okay. So are you willing to trade him for somebody else's CTO?
No.
Never, right?
Yeah.
Because why? People are unique. But are you willing to trade your $100 for my $100?
No.
If all day, you don't care, right? So this is what we look for. We look for markets where people make a difference, not money makes a difference. This is really important. Why? And we will be competing against not just other startups, but against established companies who are much larger and better funded than us. So in a market where spending makes a difference, we will always lose. Like can you outspend Apple? Never, right? You can never outspend Apple. You can never outspend Google. You can never outspend Facebook. You can never even outspend the successful local company because they will have much more money than you. So we don't want to compete on the basis of spending. What's an example? We don't want to compete in markets where how much you spend on advertising makes all the difference, or how many people you hire makes all the difference. So I think a great example of this comes from computer gaming. If you think about, every year the computer game industry has an award ceremony that's like the Oscars, where they give out awards to the games. And I remember 2 years ago, the award for the best new game was given to a game developed by an independent game studio, not by one of the big guys, not by Electronic Arts or any of the big game players, any of the big players in the game development industry. And at that time, we had a game development company called Nonstop Games that was incubating in our office. And I talked to the CEO of that company about this and asked him, what did he attribute this? Why was it that a independent game studio was able to beat all the big players in the game industry that year? And he basically said they had a team of about 20 people, and they were developing some very popular games, and they sold their company to King, which is the publisher of Candy Crush, for $100 million in 2014. And built this company pretty much from scratch. And his view was, if you get the right 20 people, you can beat any game company in the world today. Because why? Because the barriers to creating a successful game on the capital side have fallen incredibly in the last 5 years. Let's say five years ago, if you wanted to create a world-class game, you had to invest in extremely expensive hardware and software. Today, the cost of the hardware and software to develop these world-class games has fallen within the reach of small companies. So now, the barrier of capital has become less important, and what's become more important is the people. So people are a basis on which startups can compete with big companies. Why? The way I like to think about it is this. Let's imagine in your market, you have let's say on the product side, on the development side, you have the number one person in the world in your company. So, and let's say success in this market is determined by the quality of the people you have. One example might be, let's say, coming from med tech. So we work with some med tech companies. Say they have a researcher on the team that has developed a new product in a particular area, and this researcher is the number one researcher in the world in this area. So how is the big company going to compete? Just spending more money is not going to make a difference because it's all about people. So what are they going to do? They're going to get good people themselves, but what's the best that they can do if the startup already has number one?
Steal.
But let's say, let's say they try but fail and they can't steal number one. Now what do they do?
Acquire startup.
Oh, let's say, but they still want to compete. So what do they do? They can hire the number two person. With the hope that number two can beat number one. But actually, you see now the situation is totally reversed. Now the small company has the advantage over the big company because the big company has to hope that number two can be number one. The small company has number one. And now the whole competitive landscape is reversed. So we have the advantage on the small company side, not the big company side. Now, of course, this only works when people are the key to success. Because if money is the key to success, the big company always has the advantage. That's their So look for markets where people make the difference, not spending. Which brings us to the next point, which is we want to be in markets where advertising and branding are less important. This also seems a little hard to understand because we think brand is so important. But we are faced with a special problem when it comes to brand. The special problem is what? Like how? Okay, let me ask the question this way: as a startup, how valuable is our brand?
People. People. An idea.
Let's say we're just an early stage company. How powerful is our brand? Yeah. Actually, our brand is one of our most important weaknesses is our brand. Because we're new, and therefore we don't have a brand. Brand takes time to develop. The way that you become a brand is through some initial success. So you can never compete on the basis of brand because the goal of our competitive strategy is to create a brand. So it's like circular to believe we can compete on the basis of brand. And we also don't want to be in a market where advertising is the key to success. For example, I like to think about the movie industry. Like, how do you make a successful movie? What makes a successful movie? Yeah, I mean, sometimes we have good cast, good director, welcome, and etc. But most of a lot of competition in movie is based on marketing and advertising, and it's hideously expensive. So as a startup, we're not going to succeed on the basis of our advertising campaign. Now, Why? Because we don't have the money to do that. Now, of course, there are now inexpensive ways to advertise, like social media advertising, etc. But we're not going to win on that basis either, because every other startup is also trying to do that. And there's a lot of those channels are incredibly noisy. So we will have to advertise, we will market, we will build our brand, but we don't want to be competing in markets where that's a huge success. We want to be competing in markets where the product and the people are the most important.
So about marketplace, so they do need advertising for the station. I mean,
So marketplace, again, like we're gonna face the problem when we get to competitive strategy. We have a marketplace product. It is going to be successful when we reach critical mass, but how are we going to reach critical mass? If we have to reach critical mass through paid advertising, we're also probably going to fail, because we won't have enough money to reach critical mass through paid advertising. So our marketing strategy as a high-growth startup will have to include a high degree of virality in our initial advertising and marketing campaigns, meaning we're going to have to be able to target a segment where we can create target a segment and structure our value proposition in such a way that we can create a viral effect from our initial marketing campaign to enable us to reach critical mass. We'll look at some examples of that in the next section. And we look at less concentrated industries. So we would like to be in markets where we have smaller competitors. So we hope we're not in, we try not to enter markets where there are 3 giant competitors that we're going to face from day one. We like to see markets that are fragmented, smaller competitors, less concentration. And again, if you think about a market like mobile apps, I mean, who are the big publishers in mobile apps? Or how many publishers are there in mobile apps? Literally millions. So this market is highly fragmented and less concentrated, and that's another reason that it's so favorable for startups. Okay, so that brings us to the natural break point, which is we're going to move to analyzing the market after this. So it's now 4:35, so we'll take, again, 15 to 20 minute break, and we'll resume at 4:55. Okay, so Skype, so people on Zoom, we're also taking a short break. We'll be back in 20 minutes.
Okay, see you later.
Okay, see you.
you mean app publishing, like iOS or Android?
Okay. So we left off here with having, for the first half of this evening, analyzed what makes a favorable market for a startup. Now I want to go the next level down and start looking at analysis of specific markets. So, like the previous section, if you remember in the innovation and value proposition section, I break down the market, the questions about the innovation value proposition into a series of sub-questions. So I've done the same thing here for market identification analysis, where we ask 4 questions about the market, and this is a lot of the questions that investors are likely to have when thinking about your market selection and your entry segment selection. So first, looking at what is your market type. Second, how big is your market and how fast is it growing? Third, trends in the market that are favorable for the company. And fourth, your direct and indirect competitors. So first we'll look at market type. Startups will enter various market types. One is existing market. Next is a resegmented or niche market. Resegmented or niche market is a market where we identify a new segment in an existing market and enter through that niche. And a new market, which is totally new, and clone market, which is not a market that is comprised of clones, but a market that is cloned from another market. I talked about this, I think, yesterday. Cloning a market might be a geographical market. So we find a product that is already proven to be successful in another market, and then we replicate it in our market, in our geographical market, usually with some localization, or we clone a market from one product domain into another. So, for example, we take a peer-to-peer market that was developed in auctions and we apply it to accommodation or transportation. Most of us will be in the resegmented market or clone market category. Existing and new markets. Usually existing markets are not ideal, not fertile ground for startups because they're already full of competition. And really new markets usually are very difficult to build for startup companies. Our next question is about how big is our market and how fast is it growing? Now, this is I think out of all the questions on the slide, this is going to be the most important. So, how big is the market and how fast is it growing? Also implied in this is, who is your customer? So, don't forget about that, although it's not explicitly on the slide. This is another one of those questions that you never want to get from investors after you finish the presentation. You don't want to be asked, who is your customer? Because that means the presentation was not well constructed. Because who is your customer should be coming through in every presentation that you do. So next we want to look at how big is the market and how fast is it growing. This is really important. Why is it so important? Like, how big does our market need to be in order to support our scalability aspirations?
Is that a question?
Yes. So how big does the market need to be? Like, is there some lower limit on the size of our market?
At least $1 billion. Yeah.
So I think it usually works out that way. Like, it usually works out that the attractive markets for startups will be at least $1 billion. When? Today or in the future?
Oh, today. At least $1 billion today.
I mean, okay, so for me, I'm more concerned with how big is the market going to be as we're scaling. If the market is smaller today than $1 billion, I'm usually okay. But it definitely has to get to $1 billion or a reasonable threshold within the next 5 years. But where does that number come from? Like, I think it's reasonable, but why? Why $1 billion instead of 100 million or 10 billion? What is it about that billion number that makes it make sense?
It correlates to your revenue.
And okay, yeah, and then like how does that fit? How does it fit together?
It's obvious.
I mean, how much revenue are we going to have?
Some people say that you usually get only 1% of the market. Usually people say
1% of the
the market.
How about, because this woman, the growth rate of our industry is about 3 to 5% is the average number. And when we start at the start point, the after 5 years, the average growth rate of the startup is about 15 to 20. So we can market it immediately. Because it is it can be like risk market.
So wait, so what was the number?
Starting from 200 million, and then after 5 years, the 1 million. For example, the digital marketing advertisement in Vietnam is about 400. Yes, for the million, and after 5 years, it can be up to.
Yeah, I think this can work. But why, again, why like this couple $100 million up to $1 billion? Why is that so typical? Like you were talking about revenue. So how does that work? Why are we another way to think about that is why do we focus on that range? We can focus on a lot of different ranges. What is it about that range that is important for the other parameters that we're in?
Enough room for the size to scale.
So, okay, what is our definition of scale? At what size has our company reached scalability?
Century?
No, what size? When we talk about scaling a company, this means we expect the company to be able to grow to a certain size over a certain period of time. So we already talked about growth time, about 5 to 10 years. So how big do we need the company to get within 5 to 10 years in order for us to define it as having scale? What would be a metric that we could use to measure? You know what I mean? Like user, but I think that can be an important intermediate step. But let's say, maybe this is important if we're not clear on this. Like, we want to look at we're trying to build a scalable company. That means we're trying to grow to a significant size. That implies that we must have a way to measure the size, and we must have a threshold within that measure that we consider significant. So, how do we measure the size of population? And see, that's for a country. How about for our company?
Revenue.
Let's say a company has, if it has 10 million in revenue, has it reached scale?
Is the market size not market size?
I mean,
No.
the market size is an external figure. It's not about our company. You mean market share?
The market share.
So let's say a company has a 90% market share. Does it reach scale? We don't really know yet. It sounds like it should be, but what if the market is $100,000 and they have 90,000?
I think that scale means when we can plan the number of resource employees, for example, per employee, or
but let's say a company has 100 employees, has it reached scale? Sort of depends, right? Okay, so this highlights a little tricky problem that we're trying to solve, which is along what dimension should we measure our company to determine whether it has scale, or to determine what constitutes scale. And I would like to use a measure that is comparable across all companies. So it doesn't matter what industry the company is in, it doesn't matter what the business model they're using, it doesn't matter what segment they're in, but we can compare the companies using this measurement. what would that, what would be the best single dimension to measure the company along that would meet those criteria so that it's meaningful and also comparable across all industries and all segments and all business models?
Profitability.
But
Capital.
I think it's closer.
Revenue growth.
But again, like, you know, the company could have 100% month-on-month revenue growth going from $1 to $2. And they have every scale. You know what I mean? I get what you're saying. That's not bad. But okay, I want to put it this way is, what metric cannot be, full?
Valuation.
Yeah, I'm going to say, I would like to use the firm value, enterprise value, meaning what's the value of the company? Because this is comparable across all industries to determine, you know, which company is bigger, smaller, which has reached scale or not. So, and it's actually, it makes a lot of sense for us because, in fact, the reason we want to reach scale is so that we can achieve a certain level of firm value, so that we can sell the company for a reasonable return. So firm value works, and it also makes sense. So we'll define having reached scale as achieving a certain level of firm value. But what should that level be? So now we know what metric we want to measure along. What measure do we need to achieve? What is a level of firm value that indicates we have reached scale?
You mean like number?
Number.
10 million or 100 million?
Okay, so we have three suggestions, which is 10 million, 100 million, and a billion. So
a few hundred millions. A few hundred millions.
what's the number?
Hundreds.
100. Okay. So let's say we have 10 million, 100 million, and 1 billion. I want to pick the minimum. So what's the threshold above which we can feel comfortable that we have achieved scale? I think billion is definitely your scale, but I think it's too high for a threshold. You know what I mean? Like, I think if we're at a billion, we can feel comfortable that we have scale. But let's try to arrive at what's the minimum number. So the minimum number that we have on the table right now is 10. That's 10 million. Is 10 million enough? Too much. Too much? we didn't be smart with it. It's a very small one. 10, 15, 10,000. 10 million enough? I think it's definitely not enough. No. Let me put, what do I mean by that? Like, why is it not enough? When I say, okay, when we talk about scale, I talk about the company that is number one in their product category in their market. And I think even in a market, even in like Vietnam market, if you're number one, or let me put it this way, if you're number one company in your product category in your market in Vietnam, if you're the number one product in Vietnam and you're only achieving 10 million of firm value, then you chose the wrong market. Because it didn't make sense to do everything that we need to do to get to this position to achieve only 10 million in firm value. So, what would be a reasonable threshold?
Starting is 20 million.
20 million also would be too low.
100?
500 million.
500, I think. 500 is good, but now I think 500 again, it's clearly we reached scale, but it's too high for a threshold. We can still have reached scale below. So now we know it's more than 20 and less than 500.
250 million.
Wait, is your next guest going to be 125?
Yeah.
I'm sensing a pattern. Yes. Okay, so, yeah, I mean, again, okay, so I would say that to answer, the number that I have in mind is 100 million. Now, like a lot of numbers in our business, this is not a precise number. So it's not like 99 million we did with a cheap scale and 101 we did. And yeah, so, and it's also like what currency, and you know, in Vietnam, I would say it's like US dollars, but Singapore, we use Singapore dollars. So there's some, you know, like 10 to 15% variation around that. It's okay. And in real life, some companies can achieve scale even as low as, you know, 50 or 60 million dollars. But much lower than that, we can't scale. We can't achieve scale. And
Excuse me, how do you define reaching scale? Like when the valuation is $100 million, what's going to happen to the company?
what'll happen? So when the company reaches $100 million, it will be a potentially attractive acquisition target for a larger company, or it'll have a potential to get to IPO. Mm-hmm. If the company never achieves valuations in that range, it will never be an attractive acquisition target for a large company, and it'll never make it to IPO, which means it'll never exit, which means it hasn't reached scale. So, and also it means if it has achieved the #1 position in its market, it has focused on too small of a market. Mm-hmm. So, because, okay, you might wonder where these numbers come from. They're not also just made up. They come from, all the numbers in our program are related in ways that are not obvious now, but will become more obvious as we go through the program. But basically it works like this. Like, if you think about how much investment do you want?
At this stage?
Yeah, let's say let's put it this way. What's the average investment that companies raise at the seed round?
500,000.
500,000. Let's say 500,000 is like a sort of classic seed stage number. In real life, it may vary, 250, up to 500. But a typical seed range venture capital investments will be between 250 and 500. If we start with the number 500, just for understanding generally how this works, I can tell you that I will be able to, I'll show later in the program, I'll work through all the numbers, but you will see that no rational venture capital investor will invest $500,000 in a seed stage company unless that company can sell for $100 million or more. Meaning they will never get a reasonable return or you will never get the valuation that you want unless the company has the potential to sell for $100 million or more. And we are investing in companies that can be sold in trade sales or IPOs. IPO, usually the company has to have results, pretty significant results. Most companies can't IPO less than 50 million. And in most larger exchanges, the IPO value of the firm at IPO will be even more than 100 million.
Be from your China capital.
From where?
From value or China capital.
From
China capital.
firm value, market cap. So what's the total value? I'm not talking about listing in Vietnam exchange. So listing on a Southeast Asia exchange is not one of our goals either. Our goal is so our target is the company is listed on NASDAQ or we're sold to a large company. Only 2 goals. Yeah, it's very simple.
So let's say a VC invested $500,000 today, and 5 years later the venture will reach $100 million plus. And so that how much that $500,000 was when the company can IPO? like average, like how many percent of expected return that like normal VC required to invest in a company?
Okay. So, that's a very good question. What is the expected return? What we call this in our business ROI.
ROI, return on investment.
Return on investment. So, for a seed stage investment, what is a reasonable ROI that a venture capital investor will expect? Let's say over 5 to 10 years. Imagine that the trade sale or IPO will occur 5 to 10 years from the investment. So what do you think is a reasonable ROI?
28 times, 230 times.
Over 20 times.
Really?
Because last time you said that well, only 5% of companies really succeed with that.
Yeah, so 20, yeah. So usually we're looking at 20 to 30x. 20 to 30x.
You would never do it on this. Unless the Trump makes.
In the public market, right? Yeah. No, in the public listed company. So what's the average return on public listed company per year? So just to be clear, 20 to 30x, let's pick a number, let's say 30x. 30x is what percent?
30x is like 3,000%.
3,000%. Okay, so let's say over 5 years, that's I mean, it doesn't work exactly like this, but so compounding, but it's like 600%. Now, listed company returns what?
Say it again.
The return on the public equities over the long run is about what?
5%, I would say. Depend on the stage of the company.
Listed company, I mean, on average, should be like 8 to 12%. So yeah, we're looking at a huge multiple of that. Now, why are we looking at that?
Habits.
But where does that number come from?
From the probability of failing all the other portfolio.
Yeah, but, and then, yeah, you're right, that's one important factor. But that influences what? Like, okay, let me put it this way. What determines the return that the venture capital investor needs to get? What causes the, how is that driven? What drives that?
The risk.
Who knows? I mean, the risk affects it, determines the volatility in the return. But what is the underlying reason why venture capital investors need to get 30x per successful investment?
For investment.
For a successful investment.
To cover the other.
Yeah,
95%.
to cover the failures.
Yes.
And at what level? I mean, if you think about it, like, let's say I just needed to deliver 1% return versus what I'm talking about here. Like, if we walk through these numbers, we're going to see that given the portfolio expected failure rates and given a 30x return in successful companies, this means that the average annual return for a venture capital fund will be between 30 and 40%. Now, where does that number come from? If the average annual return was 10 to 20%, then the success rate, then the ROI on successful companies would be a lot less than 20 to 30x. So where does the requirement to deliver 30 to 40x come from? This comes from where? Where do venture capital investors get their money?
Investor.
Fund investors. So fund investors require what return? 30 to 40%. So the investors that are putting their money in a fund, in an early stage fund, they expect to get 30 to 40% a year. In order for them to get 30 to 40% a year, successful companies in a portfolio that has like 66% fail rates have to deliver 20 to 30x on successful seed stage investments. So it's all about cost of capital and delivering required return. If the venture fund cost of capital is 30 to 40%, then the return, and if startups are going to succeed at the rates that they tend to succeed at, then scalable, successful companies have to deliver 20 to 30x. Now let's see why this leads to 100 million in firm value. That's the original question, right? Like, let's start with a 30x required return. And a company that's raising $500,000. How much equity does that founder want to give up? How much equity do you want to give up for your 500,000?
Maybe 30%. 20 to 30.
Yeah. So let's say you want to give up 20, which is normal for founders. So you want to give up 20% for 500,000, and this means that your valuation is what?
2.5.
2.5 million. So if I want to, if I'm to get a 30x return on this investment, and the current valuation is 2.5 million, what does the valuation need to be at exit?
75 million.
So you would think 75 million, but which sounds right, but that does not account for dilution. So I will be diluted many times. The seed investor will be diluted many times before the company gets to exit. So in real life, the seed investor is lucky if they maintain 50% of their original stake by the time we get to exit. So that means in order for the investment that was invested at 2.5 million valuation to pay 30x after dilution, the valuation at exit needs to be 150 million.
Oh. Even though some anti-dilution.
But anti-dilution isn't going to affect this in most cases because anti-dilution only protects investors against excessive dilution. Excessive dilution only occurs when a company raises money in a subsequent round after at a lower valuation than they sold me my shares. In the down round. My 50% is not including any down rounds. This is just including only normal dilution. Because after seed round, the company is going to need to raise at least 3, on average, more rounds of funding to get to exit. 20% in each round dilutes me by about 50%. So that's why scalability is defined as somewhere around 100 million or more. Because given the amount of money that the startup is going to need to raise, given reasonable valuations, given reasonable exit multiples, nothing except companies that can sell for 100 million plus makes sense. Not just for investors, but for entrepreneurs either. You're not going to want to raise venture capital for a company that you can only sell for 10 million. Because, why? Because imagine, let's say I need 30x return on a company that we're going to sell for 10 million. Therefore, current valuation needs to be what?
Sorry, I didn't get the question.
Let's say let's say we look at this question from the other side, which is you can, in the end, you'll be able to sell this company for $10 million, but you want venture capital. So your current valuation is what? Must be what for you to get 30x?
Meaning like $300,000
before dilution.
That so like $200,000.
150,000. So how much money do you want?
$50,000.
Yeah. See, so now it's really hard for you to raise reasonable amounts of seed funding because the valuation is so low. So yeah. So if the company can only sell for 10 million, then you need to fund a different way. Then don't fund with venture capital. If you're going to fund with venture capital, it needs to be for a company that can sell for 100 million or more.
But like last question, how do we say that we already reached the $100 million value? How what kind of valuation method you want to use to say to back up your?
So then we have to look at in your market how are companies valued at the exit. Are they valued as a multiple of revenue?
Mhm.
Maybe, let's say in your market, companies are valued at 5 times revenue. So this means you need to achieve by the exit time frame 20 million in revenue. So that's how you justify. You say, you show your financial forecast. It shows that you have a financial model that shows that you can, and a business plan that shows you can achieve 20 million in revenue in year 5. Companies are valued at 5 times revenue in this market when they're acquired, and therefore you can sell for 100 million. Or if this is a market where companies are valued on the basis of users. So this market, companies are valued at $50 per user. We're going to have 200,000 users by year 5 at $50 each. No, 2 million users, $50 each. That would give us 100 million valuation. So, yeah, this is really important. If we feel like our company doesn't fit those description, then we're going to have a really, really hard time getting venture capital.
Wait, so in a trade sale, for instance, the company is valued by revenue, would it be like net revenue or like something like total revenue? Yeah, because net profit, something like that. Yeah, usually it's a multiple of net profit.
It depends on the market. So I would look at, one thing we also look at is comparable transactions. So look at other companies recently sold in your market. And how are those companies valued? Okay, so I think this is all good. We have gotten a little ahead of ourselves. It's okay. We'll cover this in more detail later. But now we have an understanding of the importance of firm value. And this also helps us to understand how big our market needs to be. Because if we need to sell the company for 100 million, how big does the market need to be?
The total market?
I mean, this is where our rule of thumb that it should be like $1 billion market comes from. We can, maybe make some assumption that if the market is $1 billion, somebody might be willing to pay 100 million for our company. If the market, if we're operating in a market that's, let's say, $100 million, why would anybody ever pay $100 million for a company? Doesn't make any sense. So that's where these market numbers come from. They come from like multiple of the firm value that the market needs to be in order for a transaction to make sense. Okay, so now let's look at, we talked a lot about, for a while, about how big the market needs to be. But this leaves open the question of, how do we estimate the size of our market? So estimating the size of our market is not easy because our market maybe doesn't exist today, or it's very small today. And we're also very likely to be lacking data. There's likely to be very little data about our market size. So we're going to have to make our own estimate of market size, and then we're going to have to convince investors that this is a reasonable estimate. So how are we going to do that? When we're going to be confronted with a similar problem several times in our process of developing an investable business plan. And every time we encounter that problem, we're going to approach it the same way, using the same methodology. So when I get to a point in my analysis or my project where I need to get a number I need to derive a number that is actually a very important number, but I have extremely limited data, and I have to build a model to come up with this number. I will try to estimate this number using 2 different estimation methods, and hopefully independent of each other. And then I will do the analysis in an iterative form until I get the same result from both methods of estimation. And this gives me more confidence that this number actually makes sense. Let's see.
Let's say the same number between 2 methods.
Yes, 2 methods, starting hopefully from relatively independent set of assumptions to get the same result. So this will help to alleviate the realistic concerns that investors are going to have when they look at my numbers, that they're just pulled out of the air. Okay, so we'll do that first with market size.
So
Yeah.
when we do the valuation, it's necessary to equal to 2 methods.
So so for valuation, because valuation is so important, we're going to use 3 methods.
Yeah, 2, 3 methods equal with each other.
3 methods to get the same result. So we'll even increase by 50%. Okay. So top down, the way we're going to do this is when we approach this problem of market size. So I'm trying to answer the question here, how big is my market? I'm going to look at that first from what I would call the demand side. And in order to size the market from the demand side, I'm going to use something called an approach that I call top-down market size. First, we will start with total addressable market. So in order to do that, we need to define what is the total addressable market for a product. And by total addressable market, I mean a market that can really be addressed. What does that mean? Like one thing that very quickly turns me off in investment pitches is entrepreneurs that come in and talk about, we're targeting $1 trillion market. Like, does that sound good?
Sound real.
Yeah, I think it sounds bad to me because I feel like, what is $1 trillion market? Like, what does it actually mean? I mean, tell me one market that's $1 trillion market.
Beverage market?
Like, let's say beverage market. But the beverage market has, okay, so who's the company that has significant share of that market?
Big names, Coca-Cola.
But even there, the beverage market is huge.
Yeah.
I mean, and has many different segments. So it's very difficult for one company to really attack the beverage market. Even like Pepsi, and they focus on only some Coke, or companies that make Coke and Pepsi, they focus only on some subsegments within that market. So especially like if you're targeting like the e-commerce market. E-commerce market, it's so big, and especially Southeast Asia, so fragmented. Nobody can actually address that market. So I think about what is a realistic market that you can actually address. This should be a big number, but it shouldn't be ridiculously big. If it's ridiculously big, it loses effect. Okay, so we pick a total addressable market that makes sense. And what is again, we're back to measuring the size of something. So we need to have a metric that we can use. What metric can we use to measure the size of this market? When we want to, let's say, come up with a total addressable unit of measure should we use? And let's remember the standard I had before. So we want a unit of measure that's comparable across all markets. Meaningful and comparable.
Normally it's revenue, right?
Or yeah, with dollars. You know, so we can say not number of customers, not any other intermediate unit, but dollars. So what is the total addressable market in terms of dollars? Then we pick our target within that total addressable market. So what is the target that we're going to focus on? And then we pick the entry segment in that target. And then we estimate the percentage of that segment that we can reasonably hope to acquire in the first year. And that'll give us our both top-down market size and our year one revenue estimate. So let's quickly walk through an example of that using one of our companies. Who wants to use their company?
Then you want to go for
Yeah.
your company.
It's okay. We don't have to do the real numbers. I just want to do an example. So like, okay, so what market are you in?
Advertise.
Advertising.
Digital marketing.
Okay, great. So total addressable market would be what?
Be about 400 million.
So 400 million US, and this is equal to the spending on digital marketing in Vietnam. Right? So I think that's a good total addressable market. Like it's reasonable size, it makes sense, it's big enough, and it's reasonably addressable by this company. Okay, so what's the target within that market?
The target market. The target market is the customer who are using Google and Facebook and ad networks for digital marketing. So the number is about 120 million US dollars.
Okay, great. So we would say, so target within that market are the customers that are using the Google, Facebook, and ad networks.
Yeah.
And that comes out to about 120 million. So it's about 35% of the total addressable market.
Yeah.
Okay, now what's our segment within that? So which segment do we want to approach first?
To the SME, small, medium enterprise.
So SME spending within the digital advertising market in Vietnam that is going to Google, Facebook, or ad networks. And then SME spending is how much?
That's a small fraction of their spending for the Google, Facebook, because they cannot afford the fund for running advertising through Google, Facebook for a long time. Yes.
So what's the number? So how much is that?
So I think it's about 50 million.
So the segment size is 50 million.
Yes.
And then what share of that can we capture in year one?
I think 100%.
No.
No, you have competitor.
In 1 year?
Yes.
I mean,
Yes. So,
Okay, I mean, you can try that, I think, but I think usually investors might not go.
okay.
Okay, I'll tell you what, like, how much is that? 50 million?
Yes.
So that means you would have 50 million revenue in year one?
As long as I can be deployed in the network as fast as I wish.
But is it, so can we think of an example of another company that captured 100% of their segment in 1 year?
Cannot.
Yeah. So then that's usually an argument we don't want to make. You know, it's very, it's like hard to.
Because we are talking about the market share in here, that the other don't. Doesn't mean we don't have the competitors in there, so, but we still have not exploited, right? So
Okay, actually, okay, let's start with that. So let's say, let's accept that for a minute, us. This is going to help us illustrate the process. Okay, so we would say 100% market share, which means our year one revenue should be what?
50
million. This is USD.
Yes.
Okay. So now let's do bottom up market. Let's do bottom up revenue forecast. So what's the revenue model for this company?
Advertising.
Like, how do we sell the advertisement?
Yes.
I mean, how do we sell?
We sell directly.
How do companies pay? Customers pay what?
We sell directly to the SME.
Okay, so let's say, do we only have one type of product or more than one type of product?
We have.
Let's just imagine for a minute. Let's make it simple. Let's say we just have one type of product. It's an ad that we sell to SMEs. How much does each SME pay for each ad?
What to say? 0.008.
That the SME.
1,000 Vietnamese per click.
Okay, wait. So the company, each SME pays what? 0.00.
No, I'm selling by package, for example, to the Vietnamese.
Okay, let's pick a. Okay, so you have a package.
Yes, I have a package.
How many different types of package?
Now I have about 70 contracts.
What's the
70,000 view per month.
So what type of package?
Package of view.
Oh, so how much does the package cost?
To 2 million Vietnamese.
Which is how much?
$100.
About 85.
$85. Okay. So each package costs $85, and we make money by selling the package. So that means our revenue model would be pretty simple, right? We just have one product, and then we sell $85 per package. So the revenue is determined by how many packages we can sell in the first year. So let's say if we sell $85 a package at $85, this means in year one, we have to hit 50 million in revenue, we have to sell 588,000 packages. So 588,000 packages. And this means we sell 1,613 packages per day, every day for the first year.
Impossible.
This means we sell 67 packages per hour, which means we sell 10 packages. We sell one package every minute, every day for 365 days. This is possible.
No.
No, but it's good. No, it's good, right? Because this is what I mean about we do the two methods of forecast. So let's say if our top-down method tells us that we're going to be 50 million, but our bottom-up method tells us this is not possible. So bottom-up method, now we can say, like, okay, how many SMEs are there in our target market, and then how many SMEs can we sell to per week or per month, and then what's the conversion rate on these SMEs, and then given the conversion rate on SMEs and given the pricing per package, how much revenue can we generate from the total number of SMEs that we are actually able to convert in our market in year one? And then, so let's say that number comes out to be 500,000, for example, $500,000. So then we say, okay, our top-down method told us 50 million. Our bottom-up method told us 500,000. So the right answer, or the answer we're going to be able to defend, should be somewhere in the middle. It should be in between less than 50 million, more than 500,000. So now we might say, okay, we probably believe that our bottom-up method is closer to, it's going to be easier to defend because it's actually based on our knowledge of the market and our revenue model. So then when we go, if we're looking at how do we adjust our top-down analysis to be closer to bottom-up, then we felt pretty confident in the first three numbers, the addressable market and segment. Maybe we want to revisit our market share. So if the 100% market share is giving us 50 million, but the bottom up is telling us 500,000. Maybe we have more like 10% market share or a 5% market share. And then once we change the market share number, then we can go back and look at our bottom up analysis again, and we can see how come our reasonable top down now is still higher than our bottom up. And we just repeat this process until we get a convergent result. Once we get the convergent result, now we are pretty confident that we can explain and defend this market number. Now, this doesn't mean that we have actually come up with the right answer, because there is no right answer, because nobody really knows what is the size of this market. But what it does mean is we have come up with an answer that is reasonable, defensible, reasonable, explainable, defensible, and based on our business model and our knowledge of the market. So, and this is really important because our revenue forecasts will play an important role in the rest of our business plan. Okay, now just the last two questions on this page. So, what are trends in your market that are favorable for you besides market growth? So, market growth will also have to estimate. We can estimate the market growth rate using industry analysis and analyst forecasts, but these are all just numbers. So it's useful if we can augment our growth rate numbers with trend information that supports our growth rate. Example, what are some technical or technological or social or demographic or regulatory trends that suggest that this market is going to grow fast? Like, for example, I mentioned in virtual reality, I feel that the trend in the internet and trend in processing power and trend in smartphones are supporting the growth of virtual reality market. Regulatory trends and demographic trends. Like, okay, let's think about what are trends in the market that are favorable for fintech. So which ones?
It's kind of biometric identification.
So, okay, biometric identification is a technological trend that's favorable for fintech. What else?
Other things like, you mean like in technological or other?
Oh, up to you. I mean, which one?
Blockchain.
So blockchain, yeah, blockchain is another technological trend.
Yeah, and we have that data. What big data? Big data.
Big data, okay, another sort of technological trend.
Also,
on technological trends, like how do most people access their fintech products? Mobile, and are there any technological trends underlying that?
Fintech API, so that the apps can just go to the API instead of going directly to the bank.
Okay, but how about even more basic? Does everybody have a smartphone? Yeah, I mean, so we see like the proliferation of smartphones, right? That's a very important trend. Like almost everybody has a smartphone now. Even like you start to see this, what percentage of the population in Vietnam has a smartphone? Is it growing fast or not growing fast? It's growing fast. So let's say 5 years from now, are many more people in Vietnam going to have smartphones than today? It's a fair assumption. Even worldwide, right? Many more people have smartphones in the next 5 years than have today. That trend is very favorable for fintech. Because why? Only people with smartphones can access fintech products. But therefore, right now, we're limited to fintech, to smartphone owners. But now we start to see, I saw some studies like even people in some rural areas in Vietnam, they start to have smartphones. So think about that as a huge underlying technological trend. Okay, what else? What are some other trends?
regulatory, because like the law like have started to look at the fintech, especially e-wallet, and they have some regulation about it.
Yes, governments all throughout the world and even in our region are looking at the regulatory restriction and regulatory environment and how it enables or limits fintech. And we believe that there will be increasing regulatory relaxation that enables more and more fintech companies to enter. So what else? Are there any other trends?
Demographic, is it related to like age, the age?
Millennials.
Millennials.
Yeah. So,
But it relates to the smartphone users.
but what about millennials?
Like
Anything social demographic about millennials?
they're more active and more on technology, and like they tend to use smartphone more than the elderly.
More comfortable with they're growing, born with they're born digital. They they're used to and comfortable with technology.
Yeah.
And they all have smartphones, and they're the consumer class that's growing the fastest now. And then what else?
There will be potential customers for fintech.
Okay,
in the
and
next few years.
why? I mean, any other reasons? Like, okay, do millennials like to go into the bank branch? No.
They're too young to have a bank account because the bank account requires some ID.
Well, millennials now can be 20s, 30s.
Yeah, we are millennials.
I think most of us are, a lot of us already, I get what you're saying, like there's younger millennials too. But let's say the older millennials, do they like to go into the bank? No, they hate it, right? Like our parents, did the parents like to go into the branch? They're very comfortable to do that, right? But the current generation, they don't want to go to the branch. Do they want to write paper checks? No. I mean, all the traditional banking products, they're like allergic to the traditional banking products and banking business model. So we see many technological, social, demographic, and regulatory trends that are all favorable for fintech startups. And again, this is why this is such an attractive market for startups today. And then last question, who are your direct and indirect competitors? So this is really important. I mean, I mentioned a couple of really important things on this side, but another thing I really don't like to hear from entrepreneurs is we have no competition. Because why do they think that? Another question. Yeah, that's probably why. But just because it's a new market and nobody's doing it yet doesn't mean you don't have potential competitors. So when we say who's your competition, we don't just mean right now at this moment who's selling the same product as you. We mean who are the potential competitors? Who are the companies that pose a competitive threat to your company? So we would like to see the entrepreneur is very sensitive to that they know all the competitors and they know all the strengths and weaknesses of the competitors and why they're better. So because if the entrepreneur does not know who the competitors are, they're definitely going to suffer. And just the last point on this is, what's the difference between direct and indirect competitors?
Just like direct competitor is like behind the same product. Indirect is like you distract them, the customer will not use our product as this.
Okay, that's good. I would put it this way. I would say direct competitors sell products that are similar to ours, and indirect competitors sell products that are substitutes for ours. They're not the same, but they're substitutes. So, for example, if we sell butter, other butter companies are competitors, and margarine companies are indirect. So, butter companies are direct, margarine companies are indirect. If we sell, like let's say we sell ride sharing, so let's say we're Uber, So our direct competitor is Lyft, who is selling also ride sharing. But indirect competitors are taxi companies and maybe even personal purchase of automobiles. So direct and indirect. Okay, and that brings me to the end of my workshop for today. Now tomorrow is going to be presentations by you. So I'd like every company to come prepared tomorrow to present at least the innovation value proposition part of the business model canvas. And if you want, you can start thinking about your market. You can talk about market identification analysis, but what required is the innovation value proposition questions. And we'll have, each company will have 5 to 10 minutes to present, and then we'll have question and answer and feedback after that. Okay, and this will be your first presentation in the workshop. So also, you'll be getting some feedback and questions from other participants, but also we'll try to start developing the actual presentation that you will be doing for investors. So focus on innovation value proposition questions, and if you want, you can also try to answer market identification analysis. But key is innovation value proposition. Okay, thank you. We'll see you back.
All right, then thank you. See you tomorrow.